Please remember that futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I author in my weekly written reports. Prices shown on charts and quote bars are in real time and take into account all known activity up to this point in time. If you'd like to read more of this disclaimer, simply hit the pause key on your computer screen. Welcome traders, I'm Boyd Baker, and thanks for tuning in to the fifth of a series of options tutorials. Today we're going to talk about break-even analysis. And what we mean by break-even analysis, it's simply when we're talking about buying a put or buying a call. We're not talking about what your break-even is when you're involved in an option spread or when you're writing or selling premium. When you're talking about your break-even, we're just simply adding your strike price plus the premium that you paid, plus your transaction costs, and that's going to get you to your break-even price. So in this case, you're taking your strike price, plus the premium paid, plus your commissions, and that will arrive at your break-even price. Now, a good example of this would be in the gold futures. Let's say gold is trading right here at around $1,200 an ounce. Contract size is 100 ounces. That's the standard COMEX gold. That's where we have the liquidity in the options. And a $1 move in gold equates to $100. You decide to buy a $12.50 strike price. And let's say the premium there is $450. You have a $50 commission, so your total cost is $500. Your break-even price is going to be $1,255. That's based on the formula that we talked about. Now remember, your break-even price is at option expiration. A lot can happen between now and expiration. Let's take an example of this. We're going to talk about the gold market, and this is a chart that we've had up here in previous tutorials. And we talked that the gold market is trading right here around $1,200 an ounce. The in-the-money calls would have been the 1150 calls. The at-the-money calls would be right here at the $1,200 mark. And in this example, we're talking about the 1250 calls. Now that 1250 call, we said was trading for $450 plus your transaction costs. Your break even for this out of the money option is going to be at $12.55. Well, gold's trading at $1,200, so you need to see a pretty good move in gold just to get back to break even at expiration. Now what we said is a lot can happen between now and expiration. Let's say gold is trading here in the summertime and you get a nice $25 move in gold in, let's say, a week's time. What can happen is that option premium can all of a sudden jump up on you. And let's take this example. If gold was to go from $1,200 to $1,225, what did your $1,250 call do? Well, did it make the same $25 move that the futures did, or did it move at a percentage of that? As we talked on other tutorials, we said that the delta of this option would be roughly around 30%. So it's going to pick up a percentage of that move. It's not going to move as fast as the futures. So it's roughly moving at about a 30% delta. So if the futures moves $25, that's going to equate to a $2,500 move in the futures contract. Assuming the delta on that option is approximately 30%, it's possible that that option picked up about 30% of that $25 move, or $750. In this example, gold did not hit your break-even price, and it didn't even get to your strike price. But if you had a quick move up in short order, it's probable that that option did very well for you. So if you have any questions on that, feel free to call me here at 866-973-2079.